You should remember from the aggregates unit that interest rates affect consumption spending, that they affect the amount of investment spending, and that interest rates also affect net exports. But, just in case you don't remember, here's a quick refresher on how interest rates affect each of these spending categories. Remember that the term interest rate is the price of loaned funds. If you borrow money, you must pay back what you borrowed plus interest. So if the interest rate increases, the price of loaned funds increases. In other words, the cost of borrowing money increases. So if the interest rate increases, then households will not borrow as much money as before. Households borrow money to buy things like cars, refrigerators, and washing machines. If interest rates go up, they won't borrow as much money, and because they are not borrowing as much money, they will not purchase as many cars, refrigerators, and washing machines. Consumption is households buying stuff, so since they are not buying as much stuff, consumption spending decreases. If the opposite happens and interest rates decrease, then households will want to borrow a greater amount of money since the cost of borrowing is lower, and then they will buy more stuff with this borrowed money. So when the interest rate decreases, consumption increases. As you can see, there is an inverse relationship between interest rates and consumption spending. Looking back to the investment demand curve, we can see that if interest rates were to increase, let's say 3% to 6%, then the amount of investment spending would go from $60 million to $50 million. In other words, when interest rate increases, the amount of investment spending decreases. Of course, if the opposite happened, if interest rates were to decrease, then the amount of investment spending would increase. So we can clearly see from the investment demand graph that there is an inverse relationship between interest rates and the amount of investment spending. Now, for how the interest rate affects net exports, whenever you hear interest rates mentioned in any international sector setting, you should immediately think bonds. You know who the international man of interest and intrigue is? Bonds. James Bonds. So when interest rates increase in the U.S., what happens to the desirability of U.S. bonds? They become yummy, just like this high-calorie chocolate cake. High interest rate bonds are the most desirable bonds. Foreigners wanting to buy these delicious bonds will need to get U.S. currency because they are U.S. bonds. Whenever buying anything in the United States, you need U.S. money. So foreign investors wanting to buy U.S. bonds will increase their demand for U.S. dollars. This increase in demand for U.S. dollars will increase the price of the U.S. dollar, and that means the U.S. dollar goes up in value, or in other words, strengthens. U.S. citizens with dollars in their pockets will notice, whoa, the dollar just got stronger, and with their strong dollars, they will buy foreign goods. So imports to the United States will increase. Because net exports equals exports minus imports, and U.S. imports increase, then U.S. net exports decreases. And then if we go through the process again, for when U.S. interest rates decrease, we will find that everything along the process reverses. Lower interest rates make the U.S. bonds less desirable, just like how low-calorie cakes are not very desirable. Low interest rate bonds are not so delicious. Foreign investors find they don't want to purchase as many of these undelicious, yucky, bland bonds, and since they don't want to buy as many U.S. bonds, they don't need as much U.S. currency. The decreased demand for U.S. dollars decreases the value of the U.S. dollar, and with their weak dollars, U.S. citizens will not be able to buy as many foreign goods as before. U.S. imports will decrease, and because net exports is exports minus imports, the U.S. net export figure increases. We can see from this big, long process that when interest rates decrease, net exports increase, and there is an inverse relationship between interest rates and net exports. Just in case you didn't already catch the trend, there is an inverse relationship between interest rates and consumption, an inverse relationship between interest rates and investment spending, and an inverse relationship between interest rates and net exports. So here's this unbelievably awesome machine to remind you of the relationship between interest rates and these three spending categories. Look what happens to CIG and XN when interest rates go down. CIG and XN go up. Suge. Now look at what happens when interest rates increase. Kakoi! CIG and XN all decrease. And hopefully you didn't already forget that CIG and XN are all components of AD. So if interest rates were to increase, causing CIG and XN to decrease, then AD would also decrease because CIG and XN are all components of AD. If any component of AD decreases, AD decreases, and of course if any component of AD increases, then AD increases. Now look at this poopy economy. What's the problem in this economy? If we want to fix the economy through shifting AD, which way would we want to shift AD? To the right or to the left? That's right, the poopy economy was in a recession, since the real GDP they were making was an amount less than potential real GDP. If we could fix the problem by shifting AD, we'd have to shift AD to the right. Price level would increase, but GDP would increase, hopefully reaching potential GDP. See this hand on the handle of the interest rate machine? What if that was your hand? In other words, imagine if you could control interest rates in the economy. Your powers would be awesome because you can control interest rates, you can control the AD curve. If you raise interest rates, AD decreases. If you lower interest rates, AD increases. Your power is awesome. Does anyone really have this power? Yes, the central bank of a country has this power. How does the central bank control interest rates? Well, try to recall which graphs determine interest rates in the economy. What graphs have interest rates on their y-axis and have an equilibrium point? In other words, they have both a supply curve and a demand curve. Here we go. The loanable funds market has real interest rates measured on the y-axis and also has an equilibrium point because there is both a supply and demand curve. Also, the money market graph has nominal interest rates on the y-axis and also has an equilibrium point because it has a supply and demand curve. Notice how shifting the supply curves in each of these markets would change the equilibrium point and thus change interest rates in the economy. So basically, if you had the power to wrap your fists around these curves and move them at will, you would essentially have the power to change interest rates. And because you have the power to change interest rates, you would have the power to change CIG and XN, and you have the power then to control aggregate demand. Finally, because you have power over aggregate demand, you have power over the price level and real GDP of a country, and because you have power over real GDP, you have power over the unemployment rate. Monetary policy is carried out by the central bank of a country. In the United States, the central bank is called the Federal Reserve, or more affectionately known as the Fed. A monetary policy is any action of the central bank that intends to change the money supply with the intent of changing interest rates so that interest-sensitive spending components change, like consumption, investment spending, net exports, and this then shifts AD and leads to desired changes in price level or output and employment. Since there aren't actual machine-like loanable funds market and money market graphs that the central bank can just go and wrap their fists around and shift at will, we'll now discuss what tools the central bank does have at its disposal to affect the supply of loanable funds and supply of money. Since many questions will be dealing with the United States economy, we'll focus on the Fed for most of this lesson, but other central banks like the Bank of Japan in Japan or the ECB for the EU will have the same basic tools at their disposal. And these tools are changing the reserve requirement, changing the discount rate, and open market operations. First off, the reserve requirement is the percentage of deposits that banks must keep and not loan out. Who sets this percentage? The central bank of the country, so the Fed. Let's say the reserve requirement is 10%. If the Fed wanted to increase the amount of funds a bank can loan, it could lower the reserve requirement to, let's say, 8%. That way the banks don't have to hold so much as reserves and can lend more, making more of its funds loanable. The supply of loanable funds then increases, interest rates decrease, CIG and XN increase, so AD increases, and price level and real GDP increase. Lowering the reserve requirement is an expansionary monetary policy action. Now remember that drawer full of glitter at the loan officer's desk? Every time a loan is made, the magic happens. If there are more loanable funds because the Fed lowered the reserve requirement, then more loans will be made and therefore more new money is created. So the supply of money also increases when we do expansionary monetary policy actions like lowering the reserve requirement. The opposite would happen if the Fed required banks to hold on to a greater percentage of deposits. If they increase the reserve requirement, then the banks have to hold on to more and they can't loan as much, so the supply of loanable funds decreases, the real interest rates increase, and CIG and XN would decrease, thus causing AD to decrease and therefore causing price level and real GDP to decrease. A decreased supply of loanable funds would mean less loans are being made, so less money magic happens, and the supply of money would decrease, which would also lead to higher nominal interest rates. The next tool of monetary policy we're going to cover is the discount rate. This requires, though, that you know some of the terms that go along with this and what the central bank actually does. So here's the Nihon Ginko, the Central Bank of Japan, or the Bank of Japan. And here is an ordinary person. If this person went to the central bank and asked, can I make a deposit here or can I get a loan from you? They would be told no, because the central bank is not for you and me. If we want to make a deposit or get a loan, then the banks we do our banking at are called commercial banks. In Japan, these include Mitsubishi or MUFJ, the Muffage, Mizuho, etc. In the U.S., the commercial banks would include Wells Fargo, Bank of America, etc. So we make deposits and get loans from commercial banks, but what about banks? Where do they keep their funds? Or if they want to borrow money, where do they borrow money from? That's what a central bank is for. The commercial banks actually have to keep their reserves with the central bank, and if for some reason a commercial bank can't make its reserve requirements at the end of the day, it can borrow funds from the central bank. The central bank is basically a bank for banks. I'm going to call it the mama bank, and the commercial banks are like the little babies. Now, let's say one of the babies gets into trouble at the end of the day and it can't meet its reserve requirement. Let's say the reserve requirement is 10% and Muffage has total deposits of $30 million. How much is Muffage required to have in its reserves? Yes, it's supposed to have $3 million in reserves, but let's say it only has $2.8 million in reserves at the end of the day. It has to come up with the funds that very day, and it has choices. It can either borrow the funds from a brother or sister bank, or it can borrow the money from the mama bank. If it borrows from brother or sister, it has to pay back the money plus interest the very next day. The interest rate that brother or sister banks charge to their siblings is called the federal funds rate. So let's say Mizuho charges Muffage 2% to borrow funds, then we say the federal funds rate is 2%. The bank also has the option, like I said, of borrowing the funds from mama. It will still have to pay back the funds to mama with interest, and the interest rate that mama charges is called the discount rate. So just from the names, can you guess which is typically lower? Yes, the discount rate is usually lower than the federal funds rate, but they both tend to stack together. So if the Fed raises the discount rate, the federal funds rate usually increases too. If the discount rate is very low, then banks won't worry too much about going under on the required reserves. They won't be afraid to loan. But if the discount rate and federal funds rate are very high, then commercial banks are likely to get scared and play it safe and keep excess reserves around. They won't want to make all the loans they can, of all the funds they can make available for loans, because if they get caught under their required reserves, if the discount rate is high, the cost of borrowing from mama or sister will be really high. In this way, the central bank can encourage banks to make lots of funds loanable by keeping the discount rate low, or they can scare banks into decreasing their loanable funds by making the discount rate high. The expansionary or loose monetary policy is to decrease the discount rate. This will make banks ease up on loaning funds and increase the supply of loanable funds. And with easier lending practices, more loans are likely to be made, and more magic is created where the money supply is increased. Here, the third one, open market operations. Let's say a country is experiencing a recession. The best thing for the Fed to do, as we've seen in the other tools, is for the Fed to expand the money supply or increase the supply of loanable funds. So basically, they want to put more money into society. So think of this oval as society, and then imagine that the central bank operates outside of society. What the Fed can do in times of recession is arm the bonds desk agents with money and send them into society to buy bonds. Now, the Fed's bond agents can either buy bonds from banks or from private bond dealers, since both banks and bond dealers tend to own bonds. So let's say the Fed buys the bonds from a private bond dealer. The Fed exchanges money for the bond, and now that the private bond dealer has the money, that is the bond dealer's money, because this is money that someone in society can say is theirs, like, this is my money. And because this money was not in society before, instantly the money supply increases. It's somebody's money and it wasn't money that was in society before. So that's an increase in the money supply. Now let's say the monkey instead bought the bonds from the bank. And let's say it was $1 million worth of bonds. When it exchanges the $1 million for the bond, that's $1 million at the bank, but it does not belong to a person. So because no one can say, that's my money, that $1 million is not yet counted as an increase in the money supply because it's not anybody's money, so it's not an increase in the money supply, which is a total of how much money in total people have in society. Because the $1 million is not a deposit, also, the bank doesn't have to reserve any of it, since the reserve requirement is the percentage of deposits a bank has to keep. Well, that $1 million is not a deposit, so the bank can loan out all $1 million of it, and the supply of loanable funds instantly increases by $1 million. When it does loan it out, it will probably get spent, and when that happens, the magic happens, somebody can say, I have $1 million or whatever, and then alakazam, the money supply increases at that point. What if the Fed does not want to put more money in the economy? What if it instead wants to take money out of society because there's demand pull inflation? Then the Fed will arm its agents with bonds and tell them to go sell bonds, monkeys, sell bonds. In this contractionary monetary policy, the monkeys go out and find either banks or private bond dealers to sell their bonds to. Let's say the monkeys sold $500,000 worth of bonds to a private dealer. This dealer does not just have a $500,000 sitting around their house, so where are they probably keeping the money? Yes, in a bank. So in order to purchase the $500,000 bond that the monkey is selling, the private bond dealer must make a $500,000 withdrawal from her bank account. This withdrawal will decrease the supply of loanable funds that the bank has, and since now the bond dealer has less money and the money left with the monkey out of society, then we can say the money supply also decreased. If the monkey sells the bond instead to the bank will have less loanable funds, and then it will decrease its lending, and once it decreases its lending, the money supply will also decrease. This sending out of the monkeys to either buy bonds or sell bonds is called open market operations, and it is the most important, most frequently used tool of the central banks. The expansionary open market operation is for the Fed to buy bonds, and the contractionary open market action is for the Fed to sell bonds. In that toolbox, you might have noticed there's a fourth little tool in gray. It's a lesser known and probably not very important tool, but it's called moral suasion. And basically, it's when the Fed appeals to the baby banks to do the right thing in times of economic problems. So in a recession, using moral suasion would mean the Fed just tells commercial banks, look, we're in a recession and it would be really, really helpful if you loosened up your lending and make more funds loanable. So please lend all the excess funds you have because that's just the right thing to do in a recession. That's moral suasion. In review, in a time of recession, you want expansionary or loose money policy. You want the money to flow out of the banks and into society. So think of expansionary monetary policy as wanting money to flow like water. In this case, you want to go down by the water. So you want to go down with the reserve requirement, down with the discount rate, and buy bonds, down by. In the case of demand pull inflation, there's too much money out there making people spend, which makes prices high. So we want to tighten up on the money supply and keep more money in the banks. We don't want to let that money out of the banks. We don't want so much lending to go on, so we lock the money up in the banks. And with all that money locked up in the banks, there's going to be tight money party, and the money is going to be dancing, their arms are going to be going up, and they're going to get on their cell phone and call all their money friends to come on over to the bank for the tight money party. Tight money policy involves actions like increasing the reserve requirement, increasing the discount rate, or selling bonds. So up, sell, up with your hands, up, get on your cell phone, call your friends, up, sell. Here's a summary of the actions. In economic problem, recession, you need expansionary policy to fix the recession. That would include specific actions like decreasing reserve requirement, decreasing discount rate, or buying bonds. In contractionary policy, that is best used in demand pull inflation times, then you would increase the reserve requirement, increase the discount rate, or sell bonds. On the graphs, it looks like this. In expansionary policy, the supply of loanable funds increases, decreasing real interest rates. In contractionary policy, the supply of loanable funds decreases, increasing real interest rates. On the money market graphs, expansionary policy is an increase in the supply of money, decreasing nominal interest rates, and in contractionary policy, the supply of money decreases, increasing nominal interest rates. The results of monetary policy on each of these graphs then, here's a chart that does the summary of it. Expansionary policy, supply of loanable funds increases, supply of money increases, and therefore interest rates decrease, causing CIG and XN to increase, which will cause AD to increase, which increases price level, real GDP, to increase. In contractionary policy, it's going to be the opposite. Supply on both the loanable funds market and money market decreases, increasing real and nominal interest rates, decreasing consumption, investment spending, and net exports, and therefore decreasing aggregate demand. And when that happens, price level and real GDP both decrease. Yay!